All right, we are going to take a look at a case study where we're going to go in depth on policy design, specifically the question, what split should I go with? Have you ever heard, hey, you don't want to go with a 1090 split because a higher base premium, perhaps a 30/70, 40/60 or higher, will generate higher dividends potentially over the long haul, which will give you more money. So we're going to go in depth into exactly how that works, policy design. We're going to go in depth on how dividends are calculated among whole life insurance policies, which all companies treat them different as well. We'll touch on that a little bit. Compensation, that does have a huge impact on policy performance, especially the guarantees when you look at that. We've got some case studies separately that really go in deep on that point as well. And then your money. So at the end of the day, our goal is to do what if we're interested in a cash value life insurance policy and you're in a position where you say, hey, the death benefit, yes, perhaps it's important, or maybe I don't care about it at all. The cash value is what I'm interested in. Have you ever approached a whole life insurance policy thinking, hey, I'm attracted to this because I see people who have it figured out already, companies that are doing well, that I try and mimic, whether it's from a business owner perspective or just what they're doing with their money. I see them positioning their funds in cash value, so I want to do it as well. Cash value life insurance, that is. How do I copy the people that have it figured out already? And I'll let you know that they aim to maximize the cash value as an asset on their balance sheet, whether it's personal or business, 10 out of 10 times. How do they maximize that cash value, short-term and long-term, which also results in a long-term, the greatest long-term death benefit as well. So maximize cash value. Let's first and foremost touch on policy design. So we touch on this quite a bit. Let's touch on it briefly here. If I'm going to pay any amount of money into a whole life insurance policy, I can actually, I being the consumer, I can choose where my money goes. The thing is, it can go towards either the base premium. I'll often refer to this as the initial insurance expense, or towards the PUA, stands for paid up additions rider. I'll refer to this as a cash dump in, and you'll see why here in a second. So if I'm going to pay any amount of money into a policy, let's say it's $1 I'm paying into a policy, and I can pay it towards the premium or the PUA component. Where do I want to put it? Premium dollars. If I'm paying, let's use $1,000 here per year, towards the premium piece, in respect to my cash value, I'll often see zero show up in the first and second year of a policy. As time passes, typically the third year, if I'm paying $1,000 in or $1 million, whatever that dollar figure is, I will see that begin to show up in cash value, begin to earn dividends and interest. Anything in cash value I have access to right off the bat. But the first and second year with a traditional whole life insurance policy, nothing shows up in cash value. And the reason why is really because the insurance company is overcharging me for the death benefit up front, the cost of insurance. Whereas this PUA component, this cash dump-in, if I pay $1,000 here, I will see approximately $1,000 show up in cash value. Why I say approximately depends on the company and their PUA fee. Typically, I might see pay $1,000 in, $950 to $980 immediately. Then that starts to compound and quickly overtake the fee. But that's money that begins to earn dividends and interest. And the big point of interest, it's money I can access right away, and it accelerates the cash value growth of a life insurance policy. The term paid up addition represents the fact that if I pay any amount in, say it's $3,000, it will purchase me paid up additional life insurance death benefit. Why it is paid up is this is optional. We often talk about designing a policy for a lot of flexibility, where I can have a policy where I have the ability to pay in, say, $100,000 per year, because I love the fact that it's a safe, liquid, tax-free area to position money, but I don't want to get a bill for $100 grand per year. So we can design it where I may commit to $10,000 per year and then have the ability to add more funds into the product at my discretion. So back to the policy design. Again, if you can choose where your money goes, where would you want to put it? Often we get this question, or one asks, hey, how do I put 0% of my money towards the premium and everything towards the PUA component? We cannot go quite that aggressive. And the reason why is due to limitations. We have insurance company limits and then IRS limits. The IRS limit has to do with what is called a MEC, Modified Endowment Contract. Let's just touch on insurance company limits. You'll find with a lot of the top companies, we can often drive that base premium down to about 10%. This is where we will refer to a 1090 split. Now I'll add on top of that some smaller carriers will allow you to push that base premium lower depending on circumstances. The lowest we've ever been able to drive it with a smaller carrier is typically about 3 to 3.5%, but even with that it did not make sense. Personally, I do like the major mutual carriers that all have about that 10% minimum threshold. A little bit, give or take, depending on the company you're looking at. But what that means is if I have a $1,000 base premium, I can commit to that minimum premium of $1,000 and have the ability to add more funds into the policy, the PUA component, at my discretion. Another $9,000 here. Okay. So, policy design. How do I maximize the cash value of a life insurance policy? By reducing the base premium and allocating more money towards the PUA component. That will drive my cash value up in the majority of cases. So, you may have heard that if you've watched our videos. You've heard me touch on it several times actually. Now, let's touch on a bit more here. Okay, so next we will take a look at dividends. So you may have heard the objection, this is fairly common in the industry, of how dividends work, that a higher base premium will result in a higher dividend payout. And if dividends come up, which they have to over the long haul, over the next 20, 30, 40 years, if dividends come up and I receive a higher dividend on base premium dollars, which means put more money into the base premium, well then it makes sense to do that, right? Well, here's the thing. So let's go into exactly how dividends work. I have a guaranteed rate. Let's assume first that I have a company paying a total dividend rate of 6%. That is the company's total advertised or illustrated dividend rate. What that means is they have a guaranteed rate of 4% and they declared a surplus in earnings of 2%. For a total dividend rate of 6%. How dividends are applied? Firstly, with the guaranteed portion. So if I have $1,000 per year going to the base premium and $9,000 per year going towards the PUA component, what will happen is the guaranteed rate of 4% is applied to both these areas in the exact same manner. The guaranteed rate is no more favorable to base premium dollars than it is PUAs. If we look at any guaranteed scenario with every company I've seen when we've tested this over and over again, have not seen a difference. The surplus, however, with most companies is different. So what that means, surplus, in this case, of 2%, and you're going to see this as we look at a case study here, is paid to both. However, this 2% is a little deceiving. It is way more favorable to base premium dollars with the major mutual carriers. You can look at some small companies actually, and you'll find that they pay the same dividend on base premium and PUA dollars. If you'd like more info on that, feel free to reach out to us. We're not going to put that on a public video. But we always hear the objection that all companies pay a higher dividend on base premium dollars with all companies. Like, no, all companies do things a bit differently. That's where it's good to really dig in and research different insurance carriers. So Point being here, more favorable, the surplus rate on base premium dollars with the top companies and most insurance companies as well. That is true with most insurance carriers. So the argument we sometimes hear is, hey, because you're going to receive a more favorable dividend on base premium dollars compared to PUA dollars, well, you may not want to go with a minimum premium of $1,000. You may want to go with a premium, say, of $3,000 or perhaps $4,000, because long term, you'll have more money. Have you ever heard that objection or been encouraged to do that? The thing is, you are giving up early cash value for the potential of greater long-term cash value. What I've seen, especially with corporations and studying policies and dividends for the past 40 years, dividends have gradually trickled down. We have never seen a company consistently pay higher dividends, specifically the surplus, on base premium dollars. Yes, hypothetically it is true, but we like looking at actual performance. If you haven't seen our historical performance studies or performance videos, that is available on our membership program where we go through, I believe it's 4 companies, maybe 5 actually, where we take policies from different time periods, some of which are policies people had shared with us that they'd opened personal policies, funded them, and just max funded them, did not max fund them, and we see the net internal rates of return. What am I actually earning, not just what was projected? This way, when I buy a policy, if this is my goal, I can actually accomplish it. That's the thing. How do I optimize the cash value? So the question here is, if I go with a higher base premium and sacrifice early cash value, will I see more money over the long haul? My answer is no, because I've never actually seen it. An illustration right now will say no. An illustration 7-8 years ago in a higher dividend rate would say yes, but now all of a sudden it's no. So that is an objection. We sometimes hear that a higher base premium will result in greater long-term compounding and greater long-term cash value, so it's the way to go, which I disagree with, to be very clear there. Not saying a high base premium is bad every single time. Understanding the insurance company's limitations and how much money they'll allow us to add on top of PUAs and such is very important. Now, of course, if I'm a consumer, I want to see it, not just be told about it. I also want to see what the compensation is. So if someone's encouraging me or showing me different options, well, okay, show me which one potentially gives me more money up front, more money long term, but which one also pays the agent more? Are they incentivized in any way, shape, or form to go with one option or another? And if they show you everything, then you know, hey, here's everything as far as different policy designs, different compensation, and then you, the consumer, can pick the one that's truly in your best interest, knowing or not knowing the agent's commission. I mean, it really, if the consumer asks, show them. That's how I view it. It's really not about our compensation. Do the right thing, the money will come. So, compensation on base premium dollars and PUA dollars. Remember that the PUA dollars, to go back to this, if I pay $1,000 there, how much shows up in cash value? Or if I pay any amount of money, just about all of it. If I pay any amount of money towards the premium, how much shows up in cash value in the first year? A goose egg. If I pay 30% of my net out of pocket, 30% does not show up in cash value. If it's 10%, 10% does not show up in cash value. See where I'm going? The lower you drive that, the less that does not show up in cash value, the more I can put here and have in cash value right off the bat. I know this can be a little confusing. We're going to look at numbers here in a second. So, base premium, this completely depends on the company. If you look at the top payout rates with different insurance carriers, you got to be producing a high volume of business. They're going to range typically from 85 to 135%. Call it 90% with some of the top companies on base premium in the first year. So this is year 1 specifically. And then years 2 through 10, it might average out to a 5% renewal commission. Whereas the PUA rider might pay anywhere between a 2 to 3.5% commission. Okay, let's start to visualize all this. So hopefully that helped a little bit. I know it can be confusing. Try to go through it slow and thoroughly there. Should have practiced it a couple more times. Let's take a look. Oh, almost one more objection I forgot. In respect to this is important. If we've ever heard, hey, if you go with a low base premium, this 1090 split, it will mech down the road, which, yes, it can absolutely mech like any split can. The chances of a 1090 meching are the same as a 3070, 6040, or any split really. What is important to do, and any agent can do this once they're made aware of how to do this, which we have in our Agent Academy or training program, many are not aware, is stress test a policy to ensure that it does not mech. And how we can do that is look at the guaranteed rates, a conservative dividend, the current dividend rates, and make sure that we do not trigger a mech in any way, shape, or form. If dividends come down, will I trigger a mech? No, then I'm A-okay. Where people have run into trouble in the past is they see a current illustration or report say, you're not going to mech, then they buy that policy, dividends come down the road, they run into a mech. Now they have to lessen their funding or trigger a mech. No one does that. They typically peel back on their funding. Again, know this can be confusing. Let's get into the numbers here. So what we have here is a 45-year-old male funding a policy, $50,000 per year for 10 years. A lot of stuff going on. We have a 1090 split on the left, meaning of that $50,000, $5,000 is the base premium. Cash value, first year, about $44,000. And then we have a commissions breakdown. The commission rate with this particular company is 93% in the first year only. That's why of the $5,000, commission off the base premium in year one, if that's small, is $4,650. Then they pay a 5% renewal through year 10. Some companies will pay a 1 to 2% renewal after year 10. A lot don't. But this is why we see of the $5,000 base premium, $250 is 5% of that. That's the commission the company still pays to the agent. Okay. PUAs, $45,000 commission. Well, not 45 commission. $45,000 PUA payment. The PUA commission rate, 2%. That's where the $900 comes from. For a total, first year, $5,550. And then renewals, $1,150 per year. Okay. Then we've got the cumulative commissions. Over the course of 10 years, if I'm the agent on this policy, I made just under $16,000. Okay. Now we've got some transparency as far as how the policy was designed, 1090 split, and what I, the agent, made in commission. This is also a non-mech all the way through. Then we've got a 3070 here, meaning we have a $15,000 base premium. Okay, $50,000 goes in. First year, I have $35,000 in cash value. Look at that. Here's the compensation, almost $14,000 based off the base premium. First year, $14,850. So look at that. In the first year, if I decide to sell that design, I make almost as much as I would with a 1090 over 10 years. Now, if this one produces greater cash values guaranteed and non-guaranteed for the consumer, then hey, in my mind it's okay because they have more value. Does it though? By the year 10 mark, I've got 536 here, whereas the 1090 split, I've got 573. This guy, in this tan column, actually represents the cash value difference, how much more I have with the 1090 compared to the 3070. So 10 years in, it's about $37,000. 20 years in, I've got almost $65,000 more in cash value. We can continue on here if we want, and you'll see it continue to grow over time. Now, before we progress on, here's what I want to touch on, because the theme of this video is what? policy design. The last topic was commissions. What was the middle one? Dividends. So notice this dividend column here. It reads total annual. In fact, let me clean this up real quick. Okay, there we go. So 1090 split, what do you notice here? Total annual dividend, 0 in the first year. 3070, same thing, 0 in the first year. Here's where people can get confused and kind of caught up in the emotion or the noise, call it. 1090 split, the dividend here, by the way, only reflects the surplus, not the guarantee. Very important to be aware of that. Year 2, 1,300 in the 1090, 2,560 in the 3070. Yet, I have a $17,000 cash value difference. The lower dividend here has $17,000 more in cash value. Why that is again because the guaranteed rate is applied in the exact same manner to PUAs and base premium dollars. Well, a way to simplify, I'm out of the gates fast over here. Okay. So, here we go. Let's look at the year 10 mark. I'm at 7,500. We're over here, I'm 8746. A greater surplus payout, because remember, the surplus is more favorable on base premium dollars. That's what we're seeing going on here. Yet, not a greater net cash value result. A little under $40,000 less. And then quite a bit as time passes. So again, the argument we hear here in this respect often is, well, if dividends come up, this will be pushed up to even a greater degree, dividends which are not guaranteed. And I've seen in reality with all companies, even well-designed with corporations and such, dividends tend to perform a bit under par, meaning they under-deliver from what was illustrated. Yes, I'm taking a shot at my own industry here, but at the same time, it's the truth. It's what we've seen happen in reality when we look at actual policy performance. And this, like why I lean into it so much, is this is what we've seen be the primary objection in the industry. This is my primary objection as well. Meaning I buy a policy, I see this illustration, and I think it's going to produce this because an agent said, hey, dividends should stay the same or come back up because interest rates are so low right now, but it doesn't happen. Values keep underperforming compared to that illustration. There's other reasons as to why, as far as the company's insurance expenses, mortality charges. There's other things involved in there that impact that performance. So we always like to look at the net performance, major mutuals, actual policies. We've seen that consistently deliver, and that's why corporations look at them as well. We just spoke with a bank, and guess who they're looking at without getting into any information on them? 3 carriers they considered: Mass Mutual, Guardian, and New York Life. Okay, so this guy, we've got funding for 10 years. This was a 45-year-old male. Now, we also hear, hey, after 10 years, where are you going to put the money? Here's the exact same policy funded for 20 years. So all we did here was stretch the funding for 20 years, exact same policy. If you want to rewind the video a little bit, what you'll find is everything is identical for the first 10 years. Actually, that was correct. I'm overthinking things here. Everything identical for the first 10 years. But all we did was elect to continue funding. Oh, and we've got all of the full illustrations we pulled directly from the company software. That's in our agent training program and our membership program. So here we go. For 20 years. Now, remember, on base premium, there's your commission for 10 years. Why it stopped is renewals are typically paid for 10 years. Yes, sometimes you'll see a 1 to 2% service fee, but we didn't include that here because not all companies do it. The PUA commissions would continue. Total compensation, about $25K. Over here, about $38K. This one's always going to outpace it. Now, the thing that I'd be interested in is, okay, what is the cash value difference here? Is there a difference? Let's also look at the dividend. Same thing. What do you see greater dividends on? The 30-70 split. Higher base premium results in a higher dividend. As time passes, do you see anything different in the net cash value where the higher base premium overtook it? But we do see a higher compensation. Let's look at the same thing, but stretching the funding for 30 years. And the beautiful part about this is the exact same policy where we did not have to decide up front if we wanted to stop funding in 10 years, 20 years, 30 years. We're going to look at 40 years next, where we can keep on feeding the beast, feeding the exact same policy. We do not need to take out a new policy unless we want to put in more than $50K per year. But if we don't need to take a new one out, go through the insurance expenses again, and the initial hit, the break-even point, all of that good stuff. So here we go, exact same thing. Look at your dividend column. This one, all the way through, what do you have more on? If we look at year 30, dividend, $51,000 on the 30-70 split, $46,000 on the 1090, you had more all the way through. Yet your cash value by the year 30 mark with the 1090 split, you have over $100,000 more in cash value. 30 years in, and significantly more right off the bat. Here's my mindset as a business owner, right? As we're always investing in ourselves, trying to get things going, is I do value the early equity and cash value more so than the long term. Even if a higher base premium split, 30-70, 60-40, 100%, however you want to split it, even if this gave me $100,000 more over 30 or 40 years, if I would have access to more capital in the beginning, in the early years, that's money that I can use, not to say in the first year when I have a negative hit, that I'm not a big fan of. But with that said, I've got more money up front that I can use to invest in my business, allowing me to move faster. If you're a business owner, same thing, instead of banking on the extra 1% the insurance company might give us by sacrificing our equity. Cash value keeps on moving. How far do we want to go down? We stopped it at 100. No difference there. We got 263,000 more. 40 years. Same thing with the compensation, if we look at it. With the 30-70, more from start to finish, yet less cash value for the consumer. That's the big thing. And we looked at several different splits. Here you see a 1090, 30-70, 40-60 analysis where we really went into it. And we've done every split analysis from 10, 20, 30, 40, 50, 60, 70, 80, 90, 100, and a million different variations, which is okay because they're illustrations. That's kind of neat to see as you really break it down. But again, the big thing I like to look at is reality, actual performance, not just hypotheticals. Let's touch on one other thing, because this is very valuable information, which is our MEC test. So we go through this in full detail in our Agent Academy if you're in the business. But if we ever hear the objection, a low base premium will result in a MEC. Like, no, it does not. If you drop the term rider or something like that, that'll trigger a material change. There's other things you have to be aware of as well. Here we go. So what I'm interested in, here's a MEC test where deliberately I wanted to fail, but not on the basic ledger. So when this illustration was produced, it looked perfect. An agent, a consumer looks at this and says, hey, it doesn't MEC, like I'm good. All right, let's proceed. Yet, what do we see here? Based on the current supplemental values, not a MEC. All right, based on the guaranteed supplemental values, not a MEC. Based on the midpoint values, which is about a dividend, a little over 5%, 5.1% in this example, MEC'd in year 31. That means if dividends come down and my death benefit appreciates at a slower pace, I can run into a MEC down the road. Remember, what has a direct relationship on the MEC limit or the MEC status of a policy? Age and death benefit. and also the cash value and death benefit over time past the first 7 years. Point being, it is possible to run into a mech after 7 years. So that's a test where we failed. Let's look at a test where we passed. I didn't really like failing tests in school. Drove me nuts. A lot of things drive me nuts, but I try not to show it. Here we go. This policy is not a mech based off the guarantees. Not a mech based off of the midpoint supplemental values. Based on the current supplemental values. And there's more to do as well. I mean, this stuff's important to look at and really understand. But the nice thing is, if you're in the industry, is you have these resources at your disposal. Companies have to stress test this very, very, I'm not going to put this, very, very deeply. That doesn't make sense. They have to stress test it quite a bit. So you've got this at your disposal. And if you'd like more information on it, our Agent Academy has it. If you're a consumer looking to purchase a policy, I mean, we can always disclose this to you. If you'd like to ever work with someone that's not trying to sell you a policy, or we grow our business by policy sales, our insurance side, that is no pressure. We don't do any of that. But at the same time, if you say, hey, okay, I get that, but I'd rather talk to someone that's not talking about the companies, not designing it, not selling it, but an expert in that sense, Scott Witt, he is a fee-only insurance advisor, acts as a fiduciary. I've talked to him a couple times. We're aligned in a lot of ways. Zero compensation between him and I whatsoever. However, if we introduce him to anyone, he does introduce them back. But at the same time, you say, hey, we don't want to work with Steve or those guys. He's respectful. He always puts the client first. Point being, fee-only insurance advisor and an actuary, specializes in teaching people how to maximize the cash value in a life insurance policy. Like, that's what he does. So I like that a lot. I'm like, oh man, I think about doing that sometimes instead of the policy sales side. Point being is good independent resource there that I like quite a bit. A lot of information here. Hopefully it made sense. Hopefully it didn't cause too much confusion. Can definitely create some videos on that in the future as well. If you have any questions, call, text, email anytime. We're always happy to help, whether it's setting up policies, working with policies you already have, or whatever it might be. So as always, I do hope this helps, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.